$3.7 billion gone. Why foreign investors are ditching South Africa. South African stocks hit by $3.7 billion foreign investors. South Africa's equity market is bleeding and not just a paper cut. Foreign investors have yanked $3.7 billion from South African equities since October, marking the longest losing streak in 5 years, according to the Institute of International Finance, IIF. Despite boasting one of the continent's most sophisticated financial markets, international confidence in South Africa's listed stocks has waned. In fact, equities have seen annual outflows since 2022. But this latest stretch has doubled the $1.9 billion that exited across 2023 and early 2024. The concerning part? Other emerging markets, Brazil, Turkey, Taiwan, South Korea, are now basking in fresh inflows as global investors pivot away from the US. South Africa, on the other hand, is left in the dust. Why? Investors are looking to diversify outside of the US. But that doesn't automatically make South Africa a primary destination, says Graham Tucker, portfolio manager at Old Mutual Investment Group. He adds that while the local market is relatively cheap, that price reflects a decade of declining per capita income and depressed growth. Interestingly, the Johannesburg Stock Exchange, JSE, saw a surge in activity recently, with 30 billion rand in purchases by foreign investors in just 1 week. But these gains were offset by 24.7 billion in sales. Year to date, South African stocks have delivered a 29% return in dollar terms, outperforming most global markets and trailing only Greece, Spain, Germany, and Italy, says Bank of America. Still, non-residents have been net sellers of $5.9 billion, even more than during the same period in 2024. Tucker adds, foreign investors, if anything, behave like tourists. They will come for a trade, especially in gold stocks when the commodity runs, but they won't stay without long-term policy certainty. The country's own economic pulse isn't inspiring confidence either. GDP data shows stagnation in Q1, largely due to 6 consecutive months of contraction in mining and manufacturing, according to Stats SA. Isaac Machigo, economist at Nedbank, confirms that recent trading spikes are driven more by global volatility than any improved fundamentals at home. Don't let the headlines stop here. Subscribe to X Studios for sharp, investigative coverage on African markets and global economics. From data-backed stories to deep dives into finance and policy shifts, we bring clarity to complexity. Hit that bell, drop your thoughts in the comments, and stay informed with X Studios, where the numbers tell the story.